All right, so you're really trying to get a handle on the big picture here, right? Trying to make sense of all these reports and economic indicators and political debates and how it all kind of fits together, especially when it comes to your own investments.
Yeah, it can definitely feel like a lot to process, especially with so much information flying around these days.
Absolutely. And, looking at all the stuff you sent over, the thing that really jumps out is this question of whether democracies are actually equipped to deal with these massive and growing deficits. I mean, the Gloom, Boom, and Doom report from October 2024 basically makes that the central theme. And they use a pretty specific event to kick off that discussion, the September 2024 debate between Harris and Trump.
Right, and what really caught their attention, and frankly mine too, was that immediate jump in the price of gold right after the debate.
Yeah, that was hard to miss.
And the report kind of connects those dots. They suggest that this gold price spike wasn't just some random blip, but a sign of deeper anxieties about the fiscal policies or lack thereof that both candidates were putting forward. It's almost like the market was giving a vote of no confidence in the fiscal outlook, regardless of who ends up winning.
And it wasn't just the report making that connection. Peter Schiff went on, well, X, and basically said the debate was a farce because it completely ignored these huge issues of national debt, out of control entitlement spending, and the elephant in the room, persistent inflation.
Yeah, Schiff has never been one to mince words.
Not at all.
But his reaction, I think, highlights something important, maybe a disconnect that you, as someone who's both a citizen and an investor, should really be paying attention to. It's like this gap between what gets all the attention in political debates and what a lot of economic experts are seeing as these fundamental threats to financial stability.
It's a good point. It's like two different conversations happening at the same time.
Exactly. And Bloomberg, in an editorial, they pretty much echoed that sentiment. They called it Harris and Trump Dodge America's Dire Fiscal Future, which is a pretty blunt title.
Not subtle at all.
No. And they basically argued that both candidates, in their own ways, were putting forward policies that would only dig the deficit hole deeper, even calling some of Trump's proposals reckless.
Yeah, they didn't hold back.
Yeah.
So it's not like this is just some fringe view. You've got investment analysts, mainstream media, and even some pretty prominent figures outside of politics all expressing concern.
Exactly. It really seems like there's this growing consensus, at least in certain circles, that our current fiscal path is unsustainable. And the fact that both parties are seen as contributing to the problem, that should give you pause.
It's not exactly reassuring.
No, not at all.
And it's not just opinions and editorials, right? I mean, the Penn-Wharton budget model, they crunched the numbers on both Harris and Trump's proposals. And Steve Hanke, he summed it up pretty grimly, calling it a Hobson's choice, because both paths, according to their projections, are going to add a ton to the deficit. And then you even have Clint Eastwood, which you wouldn't necessarily expect, weighing in with his concerns about a fiscal cliff. So that's a pretty diverse group of voices all singing a similar tune.
Yeah, I mean, when you've got economists, media outlets, policy analysts, and even celebrities all sounding the alarm about the same issue, it's probably a sign that something's up.
Okay, so we've talked about the general concern, but let's get into the actual numbers, the specifics of this growing deficit and debt. There's a CNBC report from August 2024 that really lays it out. The U.S. budget deficit had this huge jump, and the cost of just paying the interest on the debt we already have, that had already passed $1 trillion for just that part of the year. Just to service the debt, $1 trillion. It's mind-boggling.
Yeah, it's hard to even wrap your head around a number that big. And the fact that those interest payments were already starting to rival or even exceed some other major categories of government spending, I mean, besides the big ones like Social Security and Medicare, it just shows how this mountain of debt is squeezing the government's ability to actually fund anything else.
It's like this massive weight dragging everything down. And they projected over $1.15 trillion in interest payments for the whole year just for interest. That's crazy.
Yeah, and when you consider that the total federal budget is in the ballpark of, what, $6 trillion, having over $1 trillion of that just go towards interest is a massive drain.
It doesn't leave a lot of room for anything else.
No, it really doesn't.
And Bloomberg, they really dug into what the candidates' specific plans could mean for the debt, again, using that Penn-Wharton budget model. And their estimates were pretty alarming. They said that Trump's proposals, things like making those Tax Cuts and Jobs Act permanent, lowering the corporate tax rate even further, and getting rid of taxes on Social Security benefits, all that, they estimated that could add a whopping $6 trillion to the national debt over the next decade.
Yeah, $6 trillion, not a typo. And they projected that it would increase what they call the medium-term debt trajectory by about 10%. So we're not just talking about some small increase. It's a significant jump.
A huge jump. And then there's the whole thing about import tariffs, which Trump was talking about again. They're often presented as a way to bring in revenue, but the Bloomberg editorial was pretty skeptical. They pointed out that tariffs could backfire, leading to trade wars and actually higher prices for consumers.
Yeah, the unintended consequences of tariffs are definitely something to consider.
Right. And while Bloomberg thought Harris's plans were almost sensible by comparison, they still said that even her proposals would contribute to what they called an already unaffordable outlook.
Yeah, so it's not like either candidate was offering a clear path towards, getting our fiscal house in order.
No, not really. And Bloomberg had this pretty stark warning. They said that if we keep kicking this can down the road, eventually the financial markets are going to lose faith in the government's ability to actually pay back its debts.
Yeah, and that's a scary thought, right? We've seen sovereign debt crises happen in other countries, and they tend to pop up seemingly out of nowhere.
Like a ticking time bomb.
Yeah, and the longer we ignore these underlying imbalances, the more likely that bomb is to go off. And if you look at figures 3, 4, and 5 in the report, it's pretty clear. Those show rising interest payments, persistent budget deficits, and a ballooning gross federal debt. I mean, you don't need a PhD in economics to see that those trends just aren't sustainable.
Okay, so let's talk about this whole issue of entitlement spending, which always seems to be a hot-button topic. The Gloom, Boom, and Doom report brought in this Wall Street Journal opinion piece by Phil Graham and Jody Arrington called, get this, welfare is what's eating the budget. And their argument is, you might find this surprising, that it's actually means-tested welfare programs, not Social Security or Medicare, that are the biggest drivers of our current debt.
Yeah, it's a pretty provocative argument.
Definitely. They pointed to this massive increase in spending on means-tested programs and argued that these programs now eat up most of the government's unobligated revenue. And the fact that spending on welfare dwarfs spending on Social Security, Medicare, and even defense, that's a pretty striking comparison.
Yeah, it really challenges the conventional wisdom about where the biggest chunks of government spending are going.
Right. And some of the numbers they threw out were pretty eye-opening. They talked about how inflation-adjusted welfare payments for the average low-income household have skyrocketed since 1967, way faster than the growth in overall household income. And they paint this picture of defense spending shrinking as a percentage of revenue, while welfare spending just explodes.
Yeah, it really highlights this shift in government priorities over time.
Absolutely. And the report even included this pretty blunt quote from Charlie Munger, where he compares state-run welfare programs to, get this, an abusive relationship. He's talking about these benefits cliffs that can trap people and make it harder for them to actually work more because they're afraid of losing their benefits.
Yeah, Munger's definitely not known for being subtle.
Not at all.
But his point is important. These sudden drops in benefits when someone's income goes up, they can create this perverse incentive where people are actually discouraged from trying to earn more, which can end up perpetuating a cycle of dependence.
So it's not just about the amount of spending, but also how the programs are designed.
Exactly. The structure matters just as much as the overall cost.
All right, let's shift gears a bit. The report also touches on this whole concern about bias in the media, especially during that Harris-Trump debate. They specifically referenced this Wall Street Journal column that was super critical of ABC's moderation of the debate.
Ah, yes, the media bias debate. Always a fun one.
Right, and the accusation was basically that the moderator kept pushing back on Trump's statements while giving Harris a free pass to repeat things that the columnists considered to be outright falsehoods. No fact-checking for her, which they saw as a clear double standard.
Yeah, it's a tricky issue, right? Because there's always going to be some level of subjectivity in how a debate is moderated.
Of course. But the columnist's main point, as I understand it, is that this perceived bias can really undermine the whole democratic process. They argued that it makes it harder for voters to actually get a fair and accurate picture of the candidates and their positions if the information they're getting is being filtered through a biased lens.
Right. The idea is that a truly informed electorate needs access to neutral information.
Exactly. Okay, now let's get into what this all means for you, the investor. That's a big focus of the Gloom, Boom, and Doom report. And as we mentioned earlier, that jump in gold prices right after the debate, they saw that as a big signal.
Right. They directly link that to concerns about inflation taking off, potentially fueled by all this fiscal irresponsibility from the government.
Yeah, it's like investors were hedging their bets, moving into gold, as a way to protect themselves against potential currency devaluation.
Exactly. And John Williams, he pointed out that gold had actually overtaken his shadow stats alternative CPI, which is a measure of inflation that tends to be higher than the official CPI. So even by that more pessimistic measure, gold was starting to look really attractive as an inflation hedge.
So basically gold was screaming, Houston, we have a problem.
Pretty much. And figures 1 and 2 in the report, they actually show you that upward trajectory of gold prices. It's a pretty clear visual.
Now, while gold was doing its thing, Jim Curry, he's a technical analyst. He suggested that this big upward swing might be coming to an end soon. He said that based on his 310-day cycle for gold, which is, looking for these recurring patterns in price movements to try and anticipate future trends, he was expecting a pullback at some point.
Right, so even safe haven assets can be volatile.
Absolutely. Now, the report also revisited their earlier predictions about the bond market. Back in July 2024, they had anticipated a bond market rally, but after the debate and the Fed's recent rate cut, they were singing a different tune.
Ah, yes, the ever-changing world of market predictions.
Right. Their stance had shifted to selling long-term Treasury bonds because they were expecting inflation to stick around, which is bad news for bonds.
Yeah, when inflation's high, the fixed returns you get from bonds start to look a lot less appealing because your purchasing power is being eroded.
It's like watching your money slowly melt away.
Pretty much. And speaking of the Fed, the report interpreted their 0.5% rate cut as basically an attempt to prop up asset markets, which they weren't too happy about. It kind of feeds into their broader concern that the Fed might be more focused on preventing market crashes than on actually addressing the underlying inflation problem.
It's like they're trying to have their cake and eat it, too.
Exactly. They want to keep the markets happy without having to make the tough decisions that might actually bring inflation under control.
And what's interesting is that even with the bond market rally that they had predicted earlier, the yield on the 10-year Treasury bond, it was still way below various measures of inflation, especially when you use John Williams' higher shadow stats figures. So that raises the question, are you really making any real return on those bonds when you factor in how much your money is losing value due to inflation?
Yeah, it's a real concern. If the return you're getting on your investment is lower than the rate of inflation, you're effectively losing purchasing power over time.
You're going backwards.
Pretty much. But the report did say that there were still a couple of scenarios that could lead to another rally in Treasury bonds, like a weaker than expected U.S. economy, which could push investors towards safer assets, or even a wave of deflation coming from China, which could lower inflation expectations globally.
So it's not all doom and gloom for bonds.
No, there are always counterarguments and different scenarios to consider.
Okay, now here's a head scratcher. Even with unemployment rates relatively low and the stock market doing pretty well, the University of Michigan's Consumer Sentiment Index was surprisingly weak. It just didn't seem to line up with the other data.
That's a really interesting observation.
Yeah, and the report tried to explain this disconnect. They pointed to the fact that job growth was actually pretty uneven. Foreign-born employment was up, but native-born employment hadn't kept pace. And they also highlighted a rise in part-time work, which suggests that maybe the quality of those jobs wasn't that great.
Right, so maybe the headline numbers were making things look better than they actually were for a lot of people.
Exactly. It's like this hidden economic anxiety that wasn't really reflected in the big macroeconomic indicators.
And that kind of ties into the challenges that U.S. small businesses have been facing, which the report also highlighted. A lot of small businesses were reporting declining earnings, even worse than during the pandemic, and their sales expectations were pretty bleak.
Yeah, and that's a worrying sign because small businesses are a huge part of the U.S. economy.
Absolutely. They're often seen as a leading indicator of where the broader economy is headed. So if they're struggling, it could be a sign of trouble ahead.
And another thing that could be weighing on consumer sentiment is the rising cost of debt. The report pointed to this increase in personal interest payments, which means that more and more people are having to use their income just to service their debts, leaving them with less money to spend on other things.
Yeah, that debt burden can really squeeze household budgets and drag down consumer spending, which can then ripple through the whole economy.
It's a vicious cycle.
It can be. And then the report came back to the Fed's rate cut, and they were kind of ambivalent about it. They acknowledged that it could be seen as both irresponsible from the perspective of someone worried about inflated asset prices and also necessary relief for those struggling to make ends meet. It really highlighted the tough spot the Fed is in.
Yeah, they're damned if they do and damned if they don't.
Pretty much. And then the report made this really interesting argument about asset prices. They basically said that the price increases we've been seeing in things like Bitcoin, stocks, homes, even coffee, they argued that those aren't the actual cause of inflation, but rather symptoms of something else, those big fiscal deficits we've been talking about, and overly expansionary monetary policy.
It's like saying those rising asset prices are just the fever, not the disease itself.
Exactly.
Okay, let's shift our focus to China for a bit. The report highlighted this pretty serious deflationary pressure in the Chinese economy and talked about how that could spill over into the global economy, especially considering how huge China's share of global GDP has become.
Yeah, China's not the small player it used to be.
Not at all. And the report actually pushed back on the Bank Credit Analyst's assessment that China has a savings problem.
Hmm.
They argued that it's actually the U.S. and the U.K. that have the low savings rates, and they see China's high savings rate as kind of a cushion, something that could help them navigate their current property market downturn.
So different perspectives on the same data.
Exactly.
It just shows how complex these macroeconomic issues can be.
Absolutely. And the big question, of course, is how much of this deflation China can export to the rest of the world.
Right.
The report suggests that the U.S. might be somewhat insulated because we're less reliant on foreign trade compared to some other countries, but they think Europe is probably going to feel it more, which could lead to calls for more protectionist measures.
Which could then trigger a whole other set of problems.
Exactly. It's a global domino effect.
And it really is.
And it's interesting, the report pointed out that China's reliance on exports to advanced economies, particularly the U.S., has actually decreased quite a bit. They've been focusing more on developing economies, which means that tariffs and sanctions from the West might not be as effective as they used to be.
Yeah, China's becoming more and more self-sufficient.
Right. And this whole shift in global trade patterns, it's also reflected in how Southeast Asian stock markets have been outperforming U.S. tech and semiconductor stocks recently. It's like maybe investors are sensing a shift in where the real growth opportunities are.
It's all about finding the next big thing.
Exactly. And the report also predicts further weakening of the U.S. dollar, which they say could be good news for commodity prices in emerging markets.
Yeah, a weaker dollar tends to make commodities more affordable for buyers using other currencies, which can boost demand. And it can also make emerging market investments more attractive to foreign investors because their money goes further.
So a weaker dollar can actually be a good thing for certain asset classes.
It can, depending on your investment strategy.
Right. And in line with that outlook, the report mentioned specific emerging market financial institutions that they're bullish on. They also noted that they're sticking with their investments in Chinese and Hong Kong equities, even starting a new position in CK Asset Holdings.
So they're putting their money where their mouth is.
Absolutely. And even within precious metals, they said they're thinking about shifting some of their gold holdings into platinum, which suggests they're seeing some potential there.
Yeah, it's always good to diversify.
Right. And then they ended the investment discussion with this really provocative statement. They said the Fed is gold's best and most loyal friend because of its monetary policy decisions.
Yeah, that's a pretty bold claim.
It is, but it really gets to the heart of their skepticism about the Fed's ability to manage inflation effectively.
And their belief that the Fed's policies are actually contributing to the conditions that make gold a good investment.
Exactly.
And then, to wrap it all up, the report included quotes from Nietzsche and Hayek, two pretty heavy hitters in the world of philosophy.
Yeah, a little bit of intellectual firepower to drive the point home.
Right. Nietzsche's quote was about how we tend to double down on solutions that aren't actually working, which they seem to be applying to how governments often approach fiscal problems.
It's like the definition of insanity, doing the same thing over and over and expecting a different result.
Exactly. And Hayek's quotes were about the dangers of government-engineered inflation and the inherent difficulties of trying to centrally plan an economy.
So they're bringing these big ideas about the role of government and the limits of human knowledge.
Right. Providing a broader philosophical framework for their analysis.
So, I mean, taking all of this in, it's a lot to digest, but the overall picture isn't exactly rosy. Democracies seem to be struggling with these huge fiscal challenges, and the proposed solutions don't seem particularly promising. You've got questions about media bias, concerns about how the spending pie is being sliced up, and all of this is playing out against a backdrop of shifting global economic power and a lot of uncertainty about the future.
Yeah, it's a complex and interconnected world out there.
Absolutely. And that leaves you, dear listener, with some big questions to ponder. How might all of this ultimately affect your own personal finances and your investment strategy? What role should citizens be playing in demanding more fiscal responsibility from their governments? And with so many conflicting signals in the global economy, what indicators are you going to be watching most closely in the coming months? These are tough questions, but hopefully this deep dive has given you some valuable insights and a solid foundation to build on.
I think that's a great place to leave it. We've covered a lot of ground today.
We have. So until next time, keep those minds sharp, those portfolios balanced, and remember, in the world of finance, the only constant is change.
Well said.